Okay, we are live. Welcome everyone back to the tax Q&A. This is episode number 3. In number 1, we covered entity setup, S-corp versus LLC, which one is best, and obviously S-corp in the majority of circumstances is the entity to go with. Foreign setup, if you don't live in the United States, what that looks like. Auditing, the risk of an audit. Section 168, 179, 100% bonus depreciation. We got running your mining business as a hobby versus classified as a business in the eyes of the IRS. Active versus passive income participation. Documenting your hours. Episode 2 was bank setup, wallets, exchanges, custody, accounting, record keeping, Bitcoin-backed loans. Business credit, when is a good time to potentially sell your machines, and the critical year-end deadline to qualify for a write-off when you pay taxes in 2026. And then let's kick off this one with expansion planning. So what's the most effective strategy that you've seen in terms of how clients should roll their mining profits into additional machines tax efficiently?
Whoa, okay. Tax efficiently rolling in the mining profits into new machines. Well,
like scaling your mining setup through the income from your machines and how to set that up properly tax-wise.
Yeah, I mean, essentially, new machines purchased right now obviously will still qualify for bonus depreciation. So, you know, if you made $30,000 in mining profits and you wanted to eliminate it, you could spend $30,000 on new machines essentially, and you can get 100% bonus depreciation.
Yeah.
Aside from that, you could also take $30,000 and go to a lending platform. Coinbase just rolled out across the country their Bitcoin-backed loan. So you could borrow, I think the rate's like 7.45%. You could go up to as high as 80% loan to value, which poses a risk, especially right now with the recent decline of the price of Bitcoin. People that had loans are most likely getting their loans liquidated, which means that
or
the Bitcoin that was supporting the loan as collateral gets taken, sold to cover the outstanding note that you had until you get to a loan to value that is in line with what they're recommending.
Which they don't always just go straight to selling. They ask you to post, like, you need to put up more Bitcoin in order to not
post more Bitcoin, and if you've got other Bitcoin in other wallets, you can contribute that to like the Coinbase wallet that you put up as collateral, and that's one way to get Bitcoin out, liquidity more so, to buy more machines. I would probably stick within a range of like 40 to 50% of loan to value to be really, really safe and feel comfortable about that range.
So it sounds like then the two, like you have your mining profits, your bottom line, like net income, you can either use that to roll into new machines and like further capture the depreciation benefits, or you can take out a loan against that. So you'd still be paying taxes on that 30K net income though.
Yeah, you'd still be, well, no, you wouldn't, because you'd be buying equipment. So if I borrow,
but not like if you did the loan though. If I did
the loan, I'd not have to sell my Bitcoin, number one. So if I had appreciated unrealized gains, right, I don't have to sell that Bitcoin and realize another capital gain. Borrowing against it. It really makes sense when you've got appreciated Bitcoin that's high, that's got a low cost basis.
Or low mining basis, probably like the
low mining basis. Perhaps you've bought Bitcoin and it was at a low cost basis, and you've got a wallet with that low cost basis Bitcoin. I would use that to borrow against before I used my my Bitcoin that has a higher cost basis. Because if I want to sell any of the higher cost basis Bitcoin in the future, the capital gain's less.
Mm-hmm.
and I
So
can
it's not just
borrow against.
how you're, yeah, UTXO management in the terms of, and like just, I mean, really your coins, you want to be operating on the coins that you're not going to have the most realized gains on.
Correct. Another interesting concept is forward hash rate forward marketplace, which is
Yeah, with
something
Luxer, yeah, I've seen that. How would that apply here?
So Luxer .tech is the website. They operate a pretty large mining pool. Luxer's mining pool is where a lot of your customers may connect with, but they allow you to sell your forward hash rate, so your future hash rate of your miners today, up through 3 months, 6 months into the future for cash now. So if I have income of, let's say, $20,000 a month from my current machines, I could say, hey, Luxer, do you want to buy my future 6 months? So 6 times 20,000 a month, that's, you know, my 120,000 of future Bitcoin I can mine. Would you like to buy it now? Not all of it. They're going to give you like 25, 30%, not 100%, but they'll pay for you to put it into a contract, and now you can get liquidity out of the future of your machines.
So is that almost like a short then on hash price? Because like you're basically taking the like a fixed duration contract on hash price at whatever the current levels are or whatever it's trading at, and you lose exposure to any potential upside.
Correct.
And also I guess you get hedged against any potential downside.
You're hedging against the downside by locking in at a price now. But yeah, you lose the upside, but you get liquidity to buy more machines to run the cycle of depreciation again and have a tax benefit.
So then how would it work then, like on that machine, if you basically pulled all the earnings like to the present, then would that machine essentially, and you use that to roll into another machine, then that specific machine that you've already used the earnings from, essentially, then would it just be operating at almost a net loss because you just be paying electricity on it without any
yeah, you'd still have to pay for the electricity fees, of course. They pay you out on the revenue, so make sure you set aside
enough to pay for your
6 months of electricity money in that tranche of revenue that you took to cover the bills. So yeah, you have
how far out can you use, how far out can you purchase? Because like that seems somewhat ridiculous to me that like someone would even want to engage in such a contract of like fixed hash price when like 6 months from now hash price could be much lower or it could be much higher. Like, I mean, we've seen just in the last couple of months that it's been declining significantly. So if you would have secured a contract like that
should we drop a link so that they can go book a call?
Like in terms of what with
Luxer? Yeah.
Yeah, I mean, I honestly, I've not like spoken with a client who has experience in hash rate forwards.
Well, you could learn more, and you could book a call with Luxer to go through their program. It is rather complicated.
Have you worked with any clients that have done this?
I have not worked with any clients that have done this, but I have actually met with Luxer's team about this concept, and they've walked me through it. And it sounds very interesting. You've got to have an extensive fleet of machines for it to be worth your while. You don't want to do this with 10 miners. You know, it just doesn't make sense. The cost to the time involved to do it just doesn't make sense. So the website is luxor.tech/derivatives.
Yeah.
I'll send it to you if you want to.
Okay.
Have it displayed.
Yeah, I've heard about it before. I've never used it or spoken with somebody who has used it, but
yeah, you could book a call with them and
what's like the typical term on that? Like how far out can you?
6 months.
6 months.
That's what I've been told. Now, could that have changed? Yes, it was a month ago last time I spoke to them.
Yeah.
But I think it's just worth going through the process of learning about it and getting a call
Yeah, I
booked.
mean, if you're running a serious mining business, then it's certainly something to evaluate in terms of how you could take advantage of like the time value of having that liquidity today and being able to utilize it for, I mean, rolling into new machines or however you want to structure it. Yeah. So I suppose then the next question would be the advantage to setting up multiple different entities. Like let's just say you already have an S-corp or you already have an LLC, multi-members LLC set up. What's the advantage to adding, let's say, another entity for like almost like a different tranche or like for family members?
It really depends what your goal of adding another entity is. Let's say I have an S corporation and my best friend all of a sudden is like, hey, I want to get into mining. Okay. Do you consider adding him as a partner on your S corp? Well, what does that look like? He's got to buy the stock, right? He's got to come in and buy shares of the S corp in that regard.
Mm-hmm.
So that's fine. You could do it that way. You could do the same thing in a partnership, in an LLC. So if you're a single member LLC and now you all of a sudden want to add a partner to it, that partner can come in. And if they come in with capital to invest into the equipment, they're buying units or membership into the partnership.
Mm-hmm.
So do you want to do it where maybe instead of admitting them as an individual, you admit their S-corp as a partner? You could do that too. An S-corp can be a partner in another S-corp, or an S-corp can own an LLC. There's all different reasons why you would add another person on or structure a partnership to it's just more, you have more flexibility with an LLC to adjust things. Let's say I bring on a partner, but they want to come in with $40,000, but I want to put in $100,000. Okay. So the ownership breakdown in the LLC can be manipulated. I could change it really easily in an LLC partnership. But once we get into an S corp, you can't manipulate the ownership. You have to set up the stock and they buy the shares and they're kind of locked into that ownership percentage. So if you want flexibility in ownership, I would suggest the partnership LLC format versus the S corporation. Every situation requires a thorough discussion, and that's kind of what we do when we have our conversations with clients.
Yeah.
Not everybody is a one size fits all. Oh, you need an S corp.
Yeah.
It depends.
You
Is the
see
right
that
answer.
structure very often?
I see LLCs more often right now with the election of an S corp in the future when the profits permit going the S corp route.
Yeah. But in terms of like structuring a partnership LLC to make it easier to divide up the business, basically.
Yeah, it's just easier to split profits in an LLC because you could change ownership percentages just based on like the operating agreement. If something changes, you could change it really
Because
quick.
that would be based on shares in an S corp, right?
Yes, and you can't manipulate the shares. If we go 50-50 on an S corp and we later have a change where I want to put more money in and you don't, it becomes an issue. I've got to structure it as maybe a loan to the company. But guess what? We still split profits 50-50. So maybe I got to take a bigger W-2 salary out of it to compensate me more for me having more machines. It's annoying.
Yeah.
In an LLC, it's easy. If we're 50-50 in an LLC, and then I want to add another $100,000 to the LLC to buy more machines, I can then take the profit of that $100,000 portfolio of new machines and allocate it to me by simply changing my percentage from 50 to 75, let's say, and you go down to 25.
Yeah. That makes sense. But in terms of like not even, let's just say you're not going into it with a partnership, you're just thinking about potentially adding another entity for like another tranche of machines. When does that make sense?
Wait, say that one more time.
Like let's just say you already have an S-corp or an LLC set up. When does it make sense to add another one?
It doesn't make sense to add another one. Most of the time, you're not going to need to.
What do you mean?
There wouldn't be a need necessarily. It'd be a very unique situation, and we could go down a rabbit hole of coming up with those unique situations. But I'd rather talk to the client and hear from them first.
Yeah.
But I'm trying to think of one that would make sense. Okay, maybe you've got machines. Let's say you've got multiple hosting providers in different states, right? I can't assume everybody loves you guys, but I'm sure they do. Most people do.
Yeah.
Let's not get that wrong. But they could use other competitors, right? In theory. And let's say they're in Texas. Well, now I got to contemplate, do I want to take my current LLC and also register it in Texas? Or do I want to just form a separate LLC in Texas? And there could be reasons why you do that. Maybe there's different banks that you want to use in Texas. So you might want to form there. It could be a variety of different reasons, from liability. Maybe, shielding the assets and minimizing liability. Let's say I got sued in my mining business, right? They can't go after my second one because it's shielded under the other entity structure that has maybe more miners in it. Yeah. So you're limiting liability by opening up another entity. So that could be one reason.
Yeah, but it seems like it's not a common thing.
Not a common thing.
Yeah. No. So maybe let's jump to where an IRA comes into play here, and how leveraging, maybe it's a self-directed IRA or another variation of that, how an investor could leverage that tax advantage vehicle.
Yeah, this is a great topic. And just so everybody knows, I actually have this structure in place currently right now. So you're hearing it from the horse's mouth, somebody that's actually gone through the process to set up a self-directed IRA account with the entity structures that allow me to mine in it for Bitcoin. So basically, there are a dozen of different providers out there that will custody the IRA account. So the one that I like is directedira.com. You can open up a IRA account that is self-directed. And what that means is that you've got control over what the cash can go into. I could still.
Why would anybody ever not want that? Why would they not want control over what their cash can go into?
They don't know about it.
Like an employer sponsored.
Well, yeah, 401k is a totally separate thing, right? If I have a 401k at work, I'm not going to be able to go into a self-directed IRA. But if I separate from that job one day, I wouldn't want to leave my money in the 401k at that old employer plan. I would want to take it out into my own IRA. Now, most people that do this, and most people will go through this in their life, maybe 2 or 3 times. They leave an employer. They've got, let's say, a 401k. It's got $100,000 in the 401k. Okay. You could take it out and put it into your own IRA that you control. That's somewhat self-directed, but it's not what I'm talking about.
What's the difference between self-directed and a Roth?
Well, let's not confuse the two topics, because it's really what's the difference between traditional and a Roth. Traditional IRA is pre-tax money that took a tax deduction already. Yeah. Right? A Roth IRA is money that's already been taxed that goes into a Roth account, growing tax-free. Yeah. And when you take it out, you don't pay taxes on it.
Draws tax-free.
But let's get back to the IRA that you roll out. So we do an IRA rollover, right? From a 401k into a IRA. Most people think, oh, my E-Trade, my Fidelity account, my Charles Schwab account, my IRA. Well, what are you trading in those accounts? Mostly, it's either treasuries, it's bonds, or it's stocks.
Yeah, probably a bunch of ETFs.
And funds, mutual funds and index funds. That's all you're going to have exposure to on those types of platforms. But the second you open up what's called a self-directed IRA, I could put it in all those things. Plus, I could go into real estate. I could buy rental properties with my money in an IRA that is self-directed.
Bitcoin miners.
I could buy Bitcoin miners.
The downside, though, is anything that you have sitting in there, what is it, 55.5 or something, is you can't draw from it tax-free until 55.5.
Yeah, so it's 59.5
59.
is the hold period. And if you take it out early, it's subject to a 10% penalty plus the taxes that you incur based on your tax bracket. But you know, if you want to do this and you've got some excess money in an IRA and or 401k, you want to set this plan up, let's talk about the mechanics of it and how it's done. So it's not so scary, because it sounds scary, right? I'm self-directing my own money. Oh no, how do I do it with Bitcoin mining?
Yeah.
Well, there are really good attorneys that work with directedira.com that can set this structure up that makes sense for you with this mining IRA. And here's how it goes. You're going to need a first layer LLC. So 100 grand goes into the directed IRA account. It sits there. I can put that 100 grand into an LLC. That LLC actually has a bank account. Guess what? You control the bank account. Just don't write checks to yourself personally, because then you're taking a distribution and you got to pay taxes on it. So you have to treat this as like a real business, essentially. So it's an LLC, has a real checking account. And then that LLC owns the shares of a second LLC, which becomes your blocker corp. Okay. That's where we would conduct the mining in this second LLC. So I run the 100 grand up the chain from my first checking account to my second checking account in LLC number 2. I buy the miners in that LLC number 2. I start hashing, I collect Bitcoin. I have hosting expenses. I have to pay those out of that second LLC, writing checks, sending wires to pay the bills to the hosting provider. I've got a business functioning over there in LLC number 2. What we have to be concerned about is what's called UBIT, Unrelated Business Income Tax. The world of IRAs is tax-free growth when we have investment income. Bitcoin mining is not investment income. It's a service business. You're providing power to the blockchain. So therefore, it's subject to 37% UBIT tax. How do we skip the UBIT tax? We issue dividends back to LLC number 1. That skips the UBIT tax. Dividends are investment income. Therefore,
that's
not
so
subject
ridiculous.
to the tax.
That's so ridiculous that's how you have to set it up.
It's
so
wild.
that's like that's why you would have. Which one is the blocker LLC then? The first one is the one that avoids it. That has you want the investment income to go into the IRA in that LLC, the blocker LLC, and that's why you have like the secondary one that issues the dividends to the first one.
Yeah, it's the second one. It's basically the second LLC becomes a C corporation. Okay, because you could take an LLC and elect to be taxed like a C corporation, but you're going to do that once that second LLC actually has profits. So first year we have depreciation from the miners, and most likely we end up with a big fat negative or zero taxable income, no UBIT tax, because there's no profits left over. But year 2, I'm mining, and I'll have profits in that LLC. Now I elect C corp status. Okay, I've got the potential for profit, so I'm going to issue dividends back down. So that's how we skip that 37% UBIT tax. The C corporation will be subject to a 21% 21% corporate tax rate in the C corp level. That's the only kicker, right? But it's still it's still a good deal in the
So
end.
this is what you have set up
Yes.
in the like the main value add from this strategy for you is that you can your mining income can basically be funneled into your IRA, which you can draw from tax-free when you're 59 and a half.
Yeah, I have tax-free Bitcoin. That's what I have right now. So
Tax-free.
if that Bitcoin goes from where, if the price goes from where it's at today to be, 5 million a coin, the growth of that Bitcoin is totally tax-free when I take it out, especially because I'm in a Roth structure. I'm not in a traditional self-directed. I have a Roth self-directed. That's important to know, that you want to do this with a Roth setup. You could do it with traditional if you want, but ideally the Roth is the best, because
the main difference is like where it's taxed at between a traditional and a Roth.
Yeah, the Roth money is never going to be taxed.
Yeah.
So it's just more challenging to get money into a Roth. There's limitations. You have to pay taxes if you convert money from a 401k, like this 100 grand, for example. If I want to get that into a Roth, I have to pull it out into a regular traditional IRA. And then I've got to do a Roth conversion. And what that means is that I'm going to pay income taxes on 100 grand that I distribute out to my Roth. So figure 25% tax hit, 25 grand is the hit that you're going to have to absorb. But I want to not take the money out of the IRA conversion. Okay. I want the full 100 converting to the Roth. And then I want to pay the taxes with other money elsewhere, because it's hard enough to get money into the Roth.
What do you mean by other money elsewhere?
Other money from savings, or other money from, from income. You don't want to take a distribution of money that's in the traditional IRA to do this Roth conversion. Number one, you're going to pay the 10% penalty.
Yeah.
And then you're going to have to, that's a worse situation. So we want the full 100 being converted, and then we want to let that go to work for you in the Roth. So that is ideal for
Have you seen a lot of people use this strategy?
Not a lot of people, but once I explain it, they want to do it.
Yeah.
Do they? It costs like probably, give or take, 3 grand, give or take $500 on that. But I would say average 3 grand, because you've got to have the attorney set up the LLC structure for 2 entities. So there's a little bit of work there. It's complicated language that goes into the operating agreement for each entity, because it has to follow ERISA, ERISA rules. That's what governs the retirement system in our country, ERISA rules. So the language of the operating agreements have to pertain to ERISA rules, and that's where the attorney's expertise comes in.
Okay. So then the final structure, which it sounds like you said is the most uncommon, would be structuring like a trust, or potentially like estate planning.
Yeah.
Purposes. Explain how that would come into play here.
So the reason that people want to set up trusts is to get asset protection as they age. So for example, I had a neighbor, childhood neighbor. Their mother had a lot of money and became, getting into their 80s, became medically challenged and ill, and had to go into a nursing home. Well, she had all this money in her name, so she could afford to take money out of her stock portfolio, says the nursing home, right, and pay for the nursing home $12,000 a month fee.
Yeah, of course they're going to say that.
Right. But if this person wasn't a client, if they actually did some estate planning, they would have taken that stock portfolio account and put it into an irrevocable trust. And as long as you plan for this, there's a 5-year look back period. So if you're going to do this, you've got to wait a 5-year period. So you got to start it now, right? Put the brokerage account that's got $1 million into this irrevocable trust. Now it's out of my name. I don't own shit. I am poor on paper. And when you're poor on paper, you get government benefits.
Yeah.
That's
Medicare.
beauty. Medicare, Medicaid, whatever. That covers nursing homes, which can charge $12,000 a month. So if I have no money in my name because it's in an irrevocable trust.
So, like, let me just give you an example of, I actually have my great grandma. She had a really nice house in California, in Malibu, and she's getting into her, I think she's in her 90s. And like my grandma, so her daughter, needed to figure out how to get things set up for her nursing home. And so they decided to sell her house and basically use the proceeds from the liquidation of the real estate to fund the nursing home, which they're probably billing that old lady $20,000 a month. It's a nice luxury place, but it sounds like what she could have done is set up a trust. Then all of that is irrevocable, can't be touched, and on paper she qualifies for Medicare and doesn't have to touch any of the proceeds from selling her house in Malibu for $1.5 million.
Correct. Yeah, that's the whole thing. You want to avoid having to pay out of pocket for the elder care, because it is very expensive. As long as you've got somebody that you trust to be the trustee of the irrevocable trust, then you can kind of say, hey, I need 15 grand out of that account. Send it my way. They become your puppet in a way. So, is your kid going to screw you over? Most likely not. They
if you raise them right, they hopefully.
Listen, there's a strategy. There's a specific strategy that this type of process and planning works well for. You're going to need help from family as you get older. So you just need to take the steps and do these types of things. Otherwise, you may want to leave them money if you pass away. But if it's all eaten away by the nursing home facility, you got nothing left to leave them because you planned poorly. Yeah.
And so, like, if we apply this to Bitcoin mining, let's just say the great grandma, she doesn't sell the house. She has a mining portfolio valued at $5 million. Then she could structure those in a trust, so that way the nursing home is not going to come after her miners.
Correct. Now, that's one situation. That's one of the most common situations for estate planning. It's that exact reason where you're trying to look poor on paper and get assets out of your name by putting them into an irrevocable. There are other reasons to do it. And, imagine you've got a daughter who is going to inherit millions of dollars one day. Okay. But she's going to get married, and you don't want the future husband to have access to the inherited money. So you set up a trust for purposes of estate planning and making sure that your daughter is set up and taken care of, because maybe there is a chance that your future son-in-law gets a divorce with her. If you didn't estate plan and set up a trust, he has entitlement in the divorce to maybe 50% of her assets, which include all this money that she inherits. But if I have a trust that my daughter owns, that ex-husband can't claw back money in that trust. That's another reason that people do these things.
It's wild. Family feuds.
Yep.
So yeah, I think that's one of the more nuanced use cases, but maybe we can jump into one other smaller thing that I've come across would be sales tax exemption. we've had, and like it seems like the consensus on this is it's unclear unless you're like a distributor of machines. But like in the case of simple mining, if we had a client who wanted to try to avoid the sales tax associated with purchasing machines that are going to be running in Iowa, is it like when would that even be possible?
So if they were going to sell the machines that they bought from you, they could produce a resale
flip them basically.
Flip them, yeah. They could produce a resale certificate and give that back to you guys, and then you don't have to charge them sales tax because they were a reseller.
Yeah.
99% of the customers that you guys deal with are not resellers, so they don't qualify for this exemption for that reason. Just because you live in a different state also doesn't qualify you for exemption either. So I'd be curious on, maybe there's something that we don't know. And sure, let's see the language that explains that maybe there is a loophole, but I haven't seen it. And I've done a little bit of research in this area. You could look at Iowa's, state revenue website and go through the tax exemptions. But I don't see anything that relates to allowing somebody to be exempt from sales tax.
Yeah. Well, I think I'll jump into, I don't know if you saw this, but I'm sharing my screen. We ran this survey. So on X, it got 231 votes, which means it's not a massive sample size, but what makes you want to mine Bitcoin? Pretty simple question. And this was the results right here. The number one thing that makes people want to mine Bitcoin is like the KYC-free aspect, which if you're listening and you're not familiar with KYC is know your customer laws, which is most financial institutions in the United States need to be compliant with, which just means they need to know their customer, particularly their identity. So you have to send in a picture of your ID or something that says like you are the person that you are representing. And then they know that anything that you do on that platform is associated with your identity. And that's going to follow you anywhere. It's going to be tied to your name and your social security number. And being KYC free would mean you're doing some sort of investing, or in this case, mining Bitcoin, because you can obtain Bitcoin that is not associated with your identity. And what's kind of ironic and funny on here is this is the highest. 38% of the 231 people that voted here selected the KYC. I want Bitcoin that is not associated with my identity. And the lowest reason that people want to mine Bitcoin is the tax benefits. So those would almost be like contrasting answers here, because you have people that want KYC free Bitcoin. You could maybe suppose that they are never planning on paying taxes on the Bitcoin that's not associated with their identity. And the people at the bottom, like if you're doing it for tax benefits, obviously you don't care about the KYC free aspect because you're planning on complying with the IRS for all of your Bitcoin mining operations. And like disclaimer here, we're not saying or recommending tax evasion by any means. Obviously not. We're talking here with a tax expert. But I just thought it was funny that the number one reason that, because like if you're running your mining operation as a business, then unless you're in what was it, like a C-corp, then you effectively don't really get KYC free Bitcoin. Would that be correct to say?
Yeah, I mean, it's a common thing that comes up, KYC free doesn't relieve you from the obligation of actually reporting this on your taxes, because yes, that is tax evasion. And there's I don't see a path unless you're literally going to give your hardware wallet to somebody for cash.
It could be that maybe at some point, I mean, I don't know, maybe at some point in the future, if legislation changed, and let's just say that Bitcoin was money in the future, so dollars aren't even relevant in this equation, then like there would be no, like, you can't tax the money that you're
Yeah,
using.
but if I have a Coinbase wallet with Bitcoin in it and Bitcoin becomes currency, then my capital gains would skip the tax in that situation as well, because the government declared it a currency. Doesn't matter
Yeah,
that it's
that's true. Like
KYC'd already.
if capital gains, like if taxes on Bitcoin cease to exist, but like for the person that's mining, which I don't want to make the case for why you should be mining KYC-free Bitcoin to evade taxes, but like the person mining under a business structure right now, they need to classify all of that Bitcoin they mined as like the day it was mined, the dollar value of that is what the IRS is viewing as your income. So you're going to have some sort of tax burden unless you do things like bonus depreciation. Whereas the person who's doing the privacy mining, where they're just mining straight to their cold wallet and they're managing their UTXOs properly in the sense where nobody in the world knows except for them that they are in control of that Bitcoin, then they don't have to worry about paying any sort of tax burden on that Bitcoin. And if let's just say 5-10 years down the road, there's no capital gains tax on Bitcoin, then you affected the person that was running their business. They had a business entity set up and they were paying taxes to the IRS on the Bitcoin they were mining. They spent all of that money paying taxes on that Bitcoin. That the person that went the KYC-free route, they just skipped all of that until Bitcoin was just recognized as something that doesn't need to be taxed.
If you don't get caught.
Yeah, which I mean that's a risk. Obviously, there's trade-offs to everything, but I'm assuming like that's the logic that the reason why people chose that is they're probably going through that logic where I'm just going to get this Bitcoin that's not associated with my identity at all and sit on it for 10 years and wait for it to be something that the government's not going to try to skim a little bit off the top from me.
Yeah, I could see that being a thought. And, I guess are they going to find out a way to say, oh, these are the wallets that collected the block reward every 10 minutes of every day while mining? And do they track those wallets and say, they're not going to know who owns those wallets?
They're not. There's no way to know if somebody does it. Like people say that Bitcoin's not private. You can see the balances and you can see the numbers, but you can't see the person behind the numbers if the person is structuring it.
But they could go to the mining pools and make the mining pools KYC pretty easily. And if they KYC
which that would be like after the fact though, because right now Ocean doesn't have any KYC. Like you just need a Bitcoin address. So they could go to Ocean and say, I'm just using Ocean as an example as one that doesn't require KYC, but they could go to Ocean and say like, who mined this block or who got this portion of the block subsidy, and they'll say, this address, we don't know who it was, which they're not required to KYC now because they're not necessarily classified as a financial services company. They're not holding clients' Bitcoin. It's going straight from the block to them. They're not in the middle. They're just providing a software. So it's like some people have commented on that and say like, oh, there's going to be a crackdown and they're going to have to be KYC compliant, which, I mean, it could happen. It could not. I mean, it seems the direction that the administration and the government is going in is very like pro Bitcoin crypto policy, and like anything that would hinder these type of companies, they don't want to do that. So,
I mean but there is always a trail that is on the blockchain that can eventually lead back to a wallet that is eventually KYC'd, because you're going to go sell it on some exchange in the future. And do they hit you with back taxes?
Well, I think the thought process for these people is that they're never going to sell it. Like they would be able to just move, like they're using Bitcoin as money. Like one Bitcoin isn't $100,000. One Bitcoin is one Bitcoin. So they'll be able to send whatever. They got a little 0.01 Bitcoin payout from Ocean. They have it sitting on an address that's not commingled or like associated with any identity. Then at some point in the future, they can send that 0.01 Bitcoin to their buddy for a house. Or I mean, that would be a house probably would be a larger thing, but a Rolex or something like that, to where they don't even ever have to move it. They don't have to off ramp back into dollars again.
Yeah, in those situations, you're probably not filing a tax return and claiming miners for depreciation, tax benefits, and going through the process of actually doing a return.
Yeah.
So, you know, you could get away with it right now. It seems like
it's also
that
very
is
small.
true.
Like you're not going to be able to participate in all the structures that make the American capital markets what they are and the advantages to them and doing business within the United States. Like if you want to buy a house and you're doing this, like you can't show like, or take a loan. Like if you ever want to get financing in US dollars, like they can't see that because you're hiding it from them.
Or if you have non-KYC Bitcoin on a hardware wallet, let's say I have 3 Bitcoin and I want to borrow against it.
Yeah.
I have to lend to like a ledin.io and send as collateral 1 Bitcoin into a wallet address that
at that point it would be
went into collateral on their platform, which knows me. They've KYC me there. So now I just got Bitcoin as a loan. I borrowed against my Bitcoin, but I sent it from my hardware wallet that has non-KYC Bitcoin to a collateralized exchange account. There's the trigger tying it back to you. Now, is somebody going to put the dots together? I don't know. Hard to say.
Yeah.
But they're probably going to figure out a way to cover these loopholes soon. So act now if you want to do it.
Yeah. Yeah, that's interesting conversation. To wrap it up, maybe let's just say if you had $1 million right now, somebody handed you $1 million, how would you structure a mining investment with $1 million working with Simple Mine?
I would probably, if I'm set on putting that into miners, I would probably buy some miners now, start getting my feet wet, get used to the structure. $1 million, you're going to be stuck with a cap of being able to deduct for single filers $313,000 of loss. For married filing joint, $626,000 of business loss. The reason is there's something called the excess business loss limitation. Those are the limitations. So if I spent $1 million, the $360,000 that is in excess of the 626 rolls forward into 2026 as a net operating loss, and I can only use 80% of my income to take that loss against. So there's further limitations on that. So I'll buy some miners now, buy enough to get me a nice deduction, and then maybe upgrade and look for newer equipment and buy machines in the future as well.
You wouldn't spend the full $1 million then on miners.
What's that?
You wouldn't spend the full $1 million on mining equipment. You would just get enough to hit that limit. Or I guess that would be, this is assuming like you have like a W-2 that you want to offset. Because like obviously like it's going to vary for everybody. Like if they have a certain amount of taxable income that they want to offset and someone handed them $1 million and be like, oh, well, I'm going to go offset all my rental income or whatever the case may be. But I guess this would have just been in your case. What would you do? Like right now, let's just say like I'm giving you $1 million right now. What are you going to do with it?
Yeah, it depends. It really depends. I'd look at it carefully. I'd analyze like what's my taxable income from other sources. I'd put a lot of things together to figure out like, does it make sense that I spend the whole $1 million now? Do I think that there's going to be, some new models coming out in the next month? Do I want to plan and wait for that? How much of a tax deduction do I want in 2025? If I want something like $200,000, why would I spend the full $1 million right now? I don't need to. I want to plan this out. It's like dollar cost averaging. Do you just buy $1 million of Bitcoin today? Or do you buy a little bit over time?
I mean, with where the price is at right now, I'm doing a lump sum spot buy on whatever, 88,000, whatever it is today. I'm pulling
85. I bought at 82.
Is that what it's at right now? Is 82?
It's 85 to 80 right now. But this morning.
Yeah.
I bought at 82. I had sold some at 97. On the way down, I was like, this is probably going to drop a lot more. And sure enough, it did. So I rebought what I had sold originally. So I am, number one, I captured some capital loss.
Yeah.
And because I was mining, obviously.
Which if you want to capture capital loss, you have to keep it in cash for 30 days though, right? For like wash, that would be like wash sale.
There's no wash sale rules in crypto. So let's say I bought, let's talk about that.
Around and buy it same day.
This is a great topic right now. It's perfectly timed, because if you're out there and you bought the top, all right, you bought 126 Bitcoin, okay, 126,000, whatever. Now it's at 85. Okay, you could sell and rebuy and incur a capital loss that is now realized, and that would be nearly $46,000 if you bought it, or if you sold it at let's say you sold it at 86, right? So you'd have a $30,000 $40,000 capital loss that you can realize, and you could rebuy Bitcoin right now.
The only downside would be, I suppose, the transaction fees, which I don't know.
$1,000. It could be $1,000 in transaction fees, but 40 grand capital loss can offset 40 grand of capital gain, which tax wise is probably 11,000 of taxes. So to spend $1,000 on transaction fees is peanuts.
Yeah, that's a good deal right there. This is like tax loss harvesting, right?
Absolutely. 100%. Now, if I don't have capital gains to offset, I've got a $40,000 capital loss. 3,000 gets used on this year's tax return. 37 is remaining, and I get to carry that forward into 2026 and use it against 2026 cap gains. But you can only use $3,000 of that loss per year unless you have gains elsewhere to offset against.
Oh, okay. So I couldn't just apply it to my W-2 income?
Doesn't offset W-2 income beyond the 3,000.
Beyond the 3,000. Okay. So maybe the last concept that I've kind of just been thinking about this the last couple of weeks is the concept of mining. Like, people like to compare mining versus buying, like a $100,000 or $1 million investment into miners versus $1 million investment into Bitcoin. Which, one of the nuances there that I think is important to understand would be, when you're purchasing miners, you're effectively purchasing those miners with pre-tax dollars, so that those dollars have not been taxed yet, because they're taxed mining. Like, if you're structuring mining like a write-off, then your tax burden would be after the mining cost has been deducted. Versus if you're purchasing Bitcoin, unless you're a Bitcoin exchange, you can't purchase Bitcoin with pre-tax dollars. It's always a post-tax transaction. Like, after your income, whatever your surplus is all said and done, then the taxes take away. Then that's the portion that can be deployed into Bitcoin, spot Bitcoin.
Well, let's take taxes aside. Let's focus without tax deductions. Because remember, you got some non-KYC people out there, right, that aren't going to get the tax benefits. So does spot buying become better than buying miners and then mining it? Well, if the Bitcoin mined less the cost to mine it gives you more Bitcoin per dollar invested, then the answer is yes, buy miners. But there's a lot of variables that affect this. And obviously the number one variable is going to be the Bitcoin price.
Hash price. The
network difficulty.
The
cost to run the machines, which is normally fixed.
Your electricity cost is going to be the number one leader in terms of how profitable you are.
Right. The miner efficiency, the miner purchase price. You could look at joules per terahash, and I'm not joules per terahash, cost per terahash. So if I buy a machine and the machine is $8,000, but it's a 260 70 terahash unit, I take the $8,000 and I divide it by 270, and I'm paying $29.62 per
Yeah,
T.
there's something.
As they say.
This reminds me of a good chart that I could pull up. Is I don't know if you've seen this is hash rate index. So we were just talking about Luxor. Here we go. This is hash rate index. I mean, I look at this suite of charts frequently. The ASIC price index. I mean, this is the best one that I've found. But this gives you like historic. I mean, all time. They started it in 2018, but it gives you like the current dollar amount per terahash for various efficiency of machines. So like these would be the most efficient, under 19 joules per terahash, all the way up to like above 68 joules per terahash, which I don't even know what that would be. That would be, I think S19 is not even that bad. Like S19 would be in here, but you can see like whether like the people that bought up here, these people paid a very hefty premium on like per terahash. I mean, the latest and greatest machines at the time were 25 to 38 joules per terahash, and they were paying $120 per terahash. So that's a lot. That's a lot. And then obviously you can see it dipped and then came out. I mean, it's very volatile, the pricing of ASIC miners at the time. And then you can see that same machine that someone paid $120 per terahash on is now like whatever, even fast forward like 2 years later, and it's $15 per terahash. So I think that cheap. Oh yeah, I mean it's like you didn't do very well. I mean you're not gonna be able to outperform spot behind Bitcoin if that's what you did. But the same is true. Like you outperform spot behind Bitcoin if you bought here, and even if you sold your machine here, you sold your machine at a massive premium.
Yeah. So where are we at right now?
We're all the way over here.
Mm-hmm.
I mean, the last I mean, you can see this is like kind of interesting that the 19 to 25 actually went up. This is like in the last 3 months. It doesn't change. It's not very volatile. It's kind of this. You can see it's not moving all over the place, but yeah, it's been flat. I mean, they haven't really changed a lot. Which you can see they came down in August, and it's been flat. But like, if Bitcoin goes to 50K, then God forbid, then it would be, I mean, it's going to drop. The under 19 joules per terahash is going to go down. But yeah, I mean, this chart really just shows like your entry point for buying your machines is important in terms of you having a favorable investment. And I mean, right now it's pretty low. It's pretty low.
That means it's a good time to still buy miners.
Yeah, when hash price is, I mean, that's what I always say. When hash price is low, like here, I'll share the hash price, which ultimately, like this number, these numbers here are determined by what hash price is, which we can look at hash price per terahash, and we can see in the last 5 years, oh my goodness, it's all-time low. less than 4 cents per terahash is I mean, right over here we hit 0.043. That was the big tariff thing when Trump announced in the market.
So we want this chart to be higher one day.
Yeah, I mean, you can see times like this is the last 5 years, but you can see time. I mean, obviously, if you're mining back here, you're making $3 a terahash. But obviously, keep in mind, like back here, the terahash of machines was like 10 terahashes or something. That was like the latest and greatest machine was 10. So now like machines are 500, or even like the new there's a new hydro miner that's going to be 1 petahash. Then like the number of hashes you can produce from the same machine. So that's partially why this is lower. I mean, because difficulty has gone up. But you can see periods of time where hash price goes through like a little mini bull market. I mean, 2021 is the one that I'm most familiar with. Would be, I mean, you can see it just was going nuts. And part of that was like the price of Bitcoin just went crazy during that
difficulty
and
became a lot easier because China shut down.
Yeah, and difficulty couldn't keep up with how fast price was going up. But I mean, this right here, that was like a transaction fee spike. So I don't know if that was ordinals or what that was, but then you can see leading up to.
That was ordinals. I remember.
Yeah, well, or this was in 2023.
No, 24 was, sorry, 24.
Yeah, 2024, April of 2024 was the halving. So, I mean, you can see that this is the halving. But there was a period of time, which this doesn't really show it, but right around the period of time of the halving, there was a, I wonder if I can kind of zoom in on that a little bit better.
Yeah, I remember that because I was talking to Nick.
Yeah, April 19th, but there was a spike. Maybe it was this.
Might have been
a spike in transaction fees from the, yeah, it was just crazy. It was like the highest in terms of the percentage of reward that came from transaction fees versus the block subsidy. It was like $5 million or something in a block from transaction fees. And yeah, it was, I mean, this isn't showing it very well, but yeah, all that to say we're at all-time lows. So like to know if you're buying a miner at a bad time, like if you're buying when hash price is clearly like in an uptrend, if we see it go up to here, then, which, I mean, if it goes above where it was prior to the 2024 halving, then I mean, I would say, yeah, that's
well, what's going to drive that up is the price of Bitcoin, obviously.
Yeah.
So Bitcoin's running to 250, 300,000 one day, then this chart's going to go
or
back
transaction, like a crazy anomaly of transaction fees.
But the time period for that is so short and quick, it looks like, rather than the price of Bitcoin. Back in 21, Bitcoin hit all-time highs there.
Yeah.
So, but yeah, very good insight.
But cool. Well, I think that about wraps it up. This was a good series. We're going to be packaging all of these into the Bitcoin mining tax course, and going to be a valuable resource for that. And yeah, I appreciate your time, Mike. Where can people find you if they want to book a call, or if they want to kind of get your ear to bounce some ideas off you? How do they do that?
Yeah, our website's lcltax.com. From there, you can send us an email or call the office and schedule time. Most people do it through email, and grab my booking calendar, which I'll send to them, and they can schedule time with me in the future.
Very nice. And then Simple Mining, obviously. Simplemining.io right here.
There you go.
The mining container.
Is it hot in that container? It looks like it's a air-cooled container, but it might be pretty hot.
I'm sweating.
Sweating? Yeah, I see the sweat dripping off your hair and face. Yeah.
All right.
Take a shower, man.
Yeah, you have a great Thanksgiving, Mike.
All right, you too. Later.
All right, have a good one.